Hey everybody, good afternoon and welcome to the Supply Chain Solutions Weekly Ship Show series. Today's October 20th, 2022, and this is episode number 41 in our Ship Show series for 2022 that keeps you informed of the changing market conditions, emerging trends, and best practices in a volatile time of geopolitical intrigue and supply chain disruption and inflation. And boy, is that a mouthful. And as always, it's my pleasure to welcome my Ship Show co-host, Jason Brand, our Director of Business Development, who joins me each week on our broadcast. And finally, my name's Anthony D'Ambrosio. I'm the Vice President of Sales at Supply Chain Solutions, the company that always delivers value quickly, affordably, and flawlessly. And lastly, to our amazing Director of Marketing, Vanessa Fry, for producing today's show. We want to thank her. Well, it's that time again, folks. It's all about the FMRs, Jason would say, the freight market roundup. So please allow Jason and I to unpack the international and domestic market conditions. And with that, we will turn it over to Jason.
Thank you, sir. So, Anthony, great to be doing this. A lot going on. I'm almost a little worried we're going to be a mile wide and an inch deep today because there's a lot happening. So we'll dive into it. We'll get as far as we can, and then join us next week for anything we don't cover. I'm sure we'll bring it up. So let's start as the usual. We're going to start with our Trans-Pacific lane. So that's going to be looking at China to the US West Coast first. Remember, we're strictly looking at ocean averages here, and it's based on obviously just those ocean rates. So this lane, we've talked about it a lot. It's been a pretty wild ride the past few months. Now, I don't mean kind of like tumultuous, like up and down. It's basically just been heading straight downward. So if we go back to kind of during the pandemic when rates were still pretty high, you look back to March, rates for that ocean average were around 16,000, actually over 16,000. But just as of last week, our averages were at 2,700. And that's kind of there's a pretty big standard deviation there because we've seen rates under 2,000. So keep that in mind. Now, a little context on this. Actually, these rates last week were an increase from earlier this month. At the beginning of this month, they were around 2,000. We had like a $1,400 rate for a couple of customers, which was great. But really, this is truly a benchmarking point when you can start to say, hey, we're right back to pre-pandemic levels right now. We're in this range. So keep that in mind. Now, the difference obviously is the reasons we're here are not that, we wouldn't be here if it wasn't for these reasons that are extremely detrimental to everyone. So keep that in mind. Now, to kind of go into a few of those, we've covered a lot of them, but just kind of a few that are particular right now. So there are a lot of carriers right now cutting their Trans-Pacific services. Mediterranean Shipping Co., Maersk, CMA, CGM. They're cutting 3 Trans-Pacific services in response to these sharp drops in import demand, and also the spot market going down too. Now, this is mainly affecting the West Coast lanes, but the East Coast lanes are also seeing some reduced capacity as well. So calls by Maersk at the ports of Norfolk, Charleston, and Houston, they're going to be dropped. That was on the TP20 service that debuted back in 2021. And now they're only calling on New York, New Jersey, and Mobile. And that is a Maersk bit. Now, that isn't all that's actually changed. So during Q4, those are some of the changes that we've been seeing happening, but they've already started announcing changes happening in, during Q3. Apologies. But they've already started announcing some changes for Q4. So Maersk and Wanhai Lines, they're actually consolidating some of their Asian routes to the Pacific Northwest and in California in the fourth quarter. So they're pulling back on some of those expansions they made last year. They announced that they're going to be actually ending their TP9 service, which it's not technically ended, it's just heavily reduced. This is going to the ports of Vancouver and Seattle, and that's going to be happening this month. And then Wenheim also plans to end another 2 services, both of which called on Seattle and Oakland. So keep that in mind. Now, onto some bad news for the ocean carriers, not as much for us, freight forwarders and shippers. Now, remember, Anthony and I discussed a lot of these new ships that were going to be hitting the market back during the pandemic. There was a lot of shipbuilding orders out there. Well, they're still coming. And so obviously this is coming at the worst possible time for the ocean carriers and the buyers. So the container ship order book was just shy of 7 million TEU. That was at the beginning of October. Now, 2.6 million TEUs of that was actually due to be delivered next year, and it actually still will be delivered next year if nothing changes. And then 2.8 million of that is expected in 2024. So obviously adding to overcapacity right at a time when they're cutting services and pulling ships out of the rotation all over the place. Kind of a tough bit. A couple more things, and I know Anthony's got a ton to say. So real quick, the ILWU labor talks, they're getting a little tumultuous at the moment. Now, they're on a fast track for a strike at this point. It's definitely coming to a flashpoint. We've watched this happen for a while. The rhetoric's getting a little bit more heated. They've been out of contract for so long that obviously a lot of the worry and concern is fueling this flashpointness. So we're going to have to do a deep dive on this. We're going to do one in the coming weeks because this definitely will affect you. And strikes are kind of a thing right now, not only happening here in the US, but across the world. I'll get into that a little bit more later, though. Anthony, do you want to talk about what's happening in China at the ports of Ningbo?
Yeah, thanks, Jay. That's a great gear shift. So as everyone knows, Shanghai and Ningbo, the busiest and the third busiest container ports in the world, are closed for the second time in the last 10 days. And it's sort of a two-pronged reason. First we had, Typhoon Mufai, packing 125-mile winds and just made landfall in Shanghai and Ningbo area this past Wednesday. So the ports were closed and they were hammered by this typhoon, which would then be moving on to South Korea. So that already caused a bunch of ocean carrier delays. But most importantly, in the Bailun province in the port of Ningbo, that has been shut down because of an uptick in COVID. We actually just got word on that yesterday. So we sent out a blast of some information to our friends and partners and associates. And it's just a really tragic thing. So right now there's about 13,000 truckers in Ningbo that have received clearances to go back into the port once it opens back up. But right now we're telling everybody, please expect delays. It's going to really push back some sailings, and it's going to cause a lot of havoc for those last bits of holiday freight that were sailing out of China that would, of course, come Trans-Pacific eastbound into North America. So that's going to be problematic. Jason.
Yeah, honestly, it's ugh. So let's switch gears. Let's look at still the Trans-Pacific lane, but let's talk about what's happening if you're heading instead of into the West Coast, if you're heading into the East Coast. So in comparison to the West Coast, that actually saw a slight increase between last week and the week before, the East Coast lane has just been dropping. So it's right now it's sitting at the lowest rates of the year. It's just below 6,000 per TEU for the ocean portion. And quick diving into some of the congestion numbers, because now we're kind of looking at both sides of the US. So I counted this morning. Right now we've got 6 ships. They're waiting outside to berth at LA and Long Beach. We've got 23 ships outside of Houston, a whopping 36 ships offshore at Savannah, and roughly 18 off the coast of Norfolk. Now I want to dive into Houston a little bit. So West Coast has been seeing its volume plummeting for a lot of reasons. We've discussed a lot of them on the show over the course of the year, but Houston is seeing a very different situation. So I bunch Houston into the East Coast ports just because how the path kind of works. But they're actually seeing their Asian import volumes grow faster than their overall container volume. And it's kind of problematic for the port in general. It's causing a lot of just dilemmas in the operations, and they're operating way above their optimal point, and it's affecting their throughput. So what is going on as a result of this? The terminal is proposing an additional fee. It's going to be a long storage fee. It does not replace the demurrage fee, it is actually just on top of the demurrage fee. Now, they didn't announce a timeline. They did not announce an implementation plan, but the port director has been really vocal about this. So you should expect to see some of that stuff trickling through here in the next few weeks. Probably second week of November at the latest. You'll at least have a date of when that fee will be implemented. But yeah, they're trying to kind of get some of the containers moving. So Anthony, you want anything on that before I?
Yeah, just real quick, you made me think of it. And I kind of had some of the stats handy because I was looking at it yesterday. So Jason brings up a good point about Houston. When we talk about North American vessel dwell times right now in Houston, there are 17 vessels waiting at the anchorage, and the dwell time is averaging at 23 days right now. So we're seeing a big uptick in volume in the anchorages waiting for berthing in Houston and both Savannah. In Savannah, we have 35 vessels waiting in the queue at the anchorage with a 15-day dwell time. And if you think about the IPI, inland point, the rail backlog in both Houston and Savannah is about 4 days. And when you think about going up north, as Charleston, Norfolk, Baltimore, and New York, New Jersey, the dwell times are really minimal. I mean, New York, New Jersey, Port Newark, Port New York, it's got about a 3-day dwell time with only 11 vessels waiting at the anchorage, versus Norfolk or Baltimore, which are really vessels are only dwelling 2 days in Norfolk or 4 days in Baltimore. So, it's interesting, the dynamic that Jason brought up about Houston. And that's just, it makes sense. And I think really we saw, a cut in capacity, like, because of the Golden Week, the capacity cuts really mirrored the drop in the Trans-Pacific eastbound rates. So, as rates keep plummeting because of inflation and because, people of the world are just not buying things the way they were 6 months ago, we're going to start to see a lot of the container ship lines start to put a lot of blank sailings in. So that's something to be prepared for, because they want to drive up, they want to put a stranglehold on that capacity so they can stabilize the rates from falling any further. So something to keep a watch on.
Anthony, you made like an awesome point right there that I'm going to touch into as well. People just aren't buying stuff the way they used to, and it's going to continue for some of these just, capacity removals and things. It's just so, all the ocean container lines were making so much money that they were just like, well, we're going to buy more ships, because even if rates cut in half, we'll still be making money hand over foot. Well, rates dropped by 10 times. So it's just, oh gosh. So anyways, let's dive into a couple more of our lane analyses. And I want to kind of go deeper into what Anthony just mentioned, because I got a couple things I want to say on that. So if we're now looking at Europe, and shipments that are leaving Europe, they're heading into the US East Coast. So these rates have been bumpy. They have really been the wild ride, the tumultuous rates. So since the beginning of September, we saw the rates at an all-time low. And that was around the second week. That was around $6,700. Now, when I say all-time low, I mean all-time low in this year, for the most of the year at least, because actually they broke, no, actually that 6,700 is the lowest for this year. So for the average, at least. Now, by the beginning of October, our rate averages were back over 7,500. Now, just a couple weeks later, rates have dipped again. They're below the $7,000 point. There's a lot of reasons for this, and a few notable ones, which I'll get into in a minute. But before we dive into that, let's continue talking about Europe, but shipments coming into Europe from China. So I mention this whenever I can about this lane. Conventionally speaking, the China to European lane, it's the busiest lane in the world. There's a lot of stops between it, a ton of capacity that goes through there. It's a good barometer to use for just the ocean shipping market in general. Now, if you're looking specifically during the pandemic, obviously this lane was kind of old faithful for all the wrong reasons. It was incredibly consistent on its price in comparison to everything else. It was high, but we basically saw it find a glass floor and sit there month after month after month, while every other lane was just all over the charts. Now, thinking about this, the price floor we saw after it kind of broke through it, it landed at around 10,000. It stayed there for a few months. Now it's dropping again. So it's actually pretty steadily on the decline. Price averages have been right around $5,400 as of last week. To give you a comparison, that first kind of price floor, Anthony, do you remember, was that 16,000 or 14,000? I can't remember off the top of my head.
It was about 16,000.
That's what I figured. Yeah. So it was around 16,000. And then midway through this year, it dropped down to 10,000, stayed incredibly consistent at 10,000 for almost up until just a couple months ago. And then it's been kind of trickling downwards. We just saw a steeper decline in this price though. So this 5,400 is actually expected to continue unless a lot of things change, which there are a lot of things happening. So it could change. Now, this is kind of what I wanted to dive into about what Anthony was saying earlier. So in Europe, we're dealing with a lot of strikes right now. And we're going to start with Liverpool. So, because this has been going on for a while, it's the strikes at the port in UK. They're getting a lot more aggressive. Some of the rhetoric is also really, I mean, it's getting a lot more aggressive than it is here in the US. So after the last strike, the dock workers announced, the company called Mersey Docks and Harbor Company announced they were going to lay off 132 dock workers out of their 600 strong at that location. And the result was the dock workers announced another strike. So that's going to be beginning on the 24th and going through the November 7th, another 2-week strike. And they are not the only place that is experiencing this. So it's happening literally all across the European Union right now and Europe in general. And it's happening in all different industries. So France has a few different strikes going on. One's happening at Total Energies. They actually had a lot of those strikes just ended, but 2 of the locations are still striking. In the nuclear sector in France, there is strikes occurring currently at 20 of the 56 nuclear power plants. And then also France just on Tuesday had about half of its normal railway capacity because of strikes happening in that sector as well. Britain has their beer delivery drivers, about 1,000 of them are striking. Nearly 2,000 of the staff at the nuclear weapons establishment. They make nuclear warheads and they maintain nuclear warheads. They're considering a strike, which would start October 24 and last for 2 weeks. We've got 300,000 nurses in Britain considering a strike. And all of these are really over. They want more pay and better working hours. But the strikes do continue. Lufthansa saw strikes. They're supposed to end today. Actually, they started on Monday, and this was over just the hours that the pilots were operating. And then, you know, there's strikes even happening in the Czech Republic, Belgium, and Hungary as well. So there are a lot of things happening in Europe at the moment. There's a lot to dive into in the energy sector as well. We really don't have time to give a good explanation of all the things going on because obviously a lot of this is hinging on some of the energy issues happening, among other things. So, Anthony, you want to add to that?
Just real quick, because I know we're pressed for time. Just to piggyback on what you said, I just want to say that, you know, the demand does remain slow in Europe. There is space available, despite the scheduled reliability continuing to be affected by the large number of blank sailings and vessel sliding and port emissions that the carriers are, you know, implementing. But there is serious port congestion in Europe, particularly Hamburg and Rotterdam, and this continues to cause delays and late return of vessels to Asia. So that impacts, you know, everything is, you know, goes in a cycle, and it's going to impact everything. So, you know, the ongoing pressure for spot rates is, you know, due to low demand is a constant, and, you know, there is equipment available, but the impact of the blank sailings and the vessel delays is starting to take its toll. So I would just say to everyone, as Jason mentioned earlier, please be flexible when planning your shipments due to the anticipated congestion and delays going on in Europe and the strikes. Back to you, Jay.
Yeah, Anthony, that's a really awesome segue too, because thinking about air, we had the show talking about air last week. You know, if you, more flexibility you have, specifically shipping right now out of Asia to the US, you could see some substantial savings just from having flexibility. If you're booking at the last minute, you could have an all right cost per kilo, or it could be outrageous in comparison to what you could have had. So kind of looking at what's been happening at our rate trends week over week, we're just seeing this massive seesaw effect. And so we're seeing just rates spike. So right now we're sitting at roughly $6.03 a kilo. Last week we were at $4.80 a kilo. The week before we were at $10 a kilo. So the more flexibility you have in when you can make your shipment possible, trust me, we can actually turn that into savings. So try to get those shipments over to us or your logistics provider as soon as possible, as many weeks in advance as possible, and kind of discuss what you're seeing with rates, what you're hearing about rates, and where you can kind of dive in, or what your target price is, to see if they can kind of work on that for you. Now, thinking about Europe, Europe's been really steady on the cost. It's been really steady for a very long time. We discussed this back in early spring. A ton of capacity actually got just entered into the European market. And that was because of e-commerce companies, obviously like Amazon, but also United. United added in over 100 flights. Now, granted, that's not 100 new planes. That's just different kind of, combinations of lanes and things, some being passenger, but all of which were carrying some level of cargo. So it really has helped the price stability when it comes to shipping air out of Europe. Obviously, there's a lot of congestion, things going on, so that can threaten it at certain terminals at certain times. But in general, it's been pretty good. So what we've seen is about $3 a kilo. And the last time we talked about this, it was only a couple cents more. And we saw, and just looking at the price averages, it's been pretty consistent, which is great. Now, looking at South American air freight, if you are shipping from Central or South America, you are enjoying some of their lowest rates you've seen, not the lowest, but some of the lowest. Right now, it's around $2.90 a kilo. And now this is also a kind of a tricky rate as well. This will change pretty violently. So, if we've got a good rate, you should definitely, and if you're thinking about moving air cargo, jump on it right now, because it can spike just as bad. Well, not quite as bad as Asia, but it can spike pretty bad as well. Anthony, you want to add anything to that before I move on to fuel?
No, I mean, you're spot on as always. I mean, it's just, I wish everywhere else in the world was sort of running like the Americas, because they're sort of running at a normal pace, and there's not a lot of major issues on the air freight side. And the rates are kind of going week to week, right? They're remaining stable week over week, but then every once in a while we see a spike. And I think Jason mentioned this earlier, especially out of Europe. I mean, you have to be wary of the handler strike at the airport in Heathrow, and then also in Charles de Gaulle, that could affect operations over the next 2.5 to 3 weeks. Air Canada just announced beginning October 1st that they're going to operate 2 nonstop freighters per week from St. John's to Frankfurt, as well as 3 nonstop freighters per week into Madrid. So, there's a lot of stuff going on in the air freight market. But Jason, go ahead. I think we need to move on.
No, that's fantastic. And I agree. There is a lot of fun stuff happening in the air market, and it's been kind of like winding up for a while now, which is kind of cool. So fuel, you guys have probably been watching this because it's affecting all of us from a consumer standpoint as well, even if you don't drive a diesel. So, obviously we've seen kind of fuel prices spike over the past couple of weeks, and kind of like, change as far as the rate they were spiking. I would call this fluttering. So technically gasoline has actually gone down slightly in the past couple of weeks after a quick spike. But on the opposite end of the spectrum, diesel is it's just quickly trending upwards. So right now, price averages for diesel across the US are sitting at around $5.34 a gallon. If you compare that to 2 weeks ago, that was an increase of over 50 cents a gallon in just a 2-week span. So that is a huge increase. Actually, it's the quickest pace of increase we have seen since all of this fuel stuff started to go haywire in earlier this year. So keep that in mind. Now, if we're talking about the velocity of this change, most of that increase happened 3 weeks ago, 3 weeks to 2 weeks ago. So there was a 75% price increase that happened in that first week, and then the remaining 25% happened in the following week. So velocity slowing down. And to keep this in mind, there is kind of a ceiling price, which is when it kind of maximized in the beginning of the year. We're getting near that point, so you should expect it to not continue to the rate it was. So yeah, tongue twisters.
Absolutely.
That's what I got on fuel. Anthony, you want to add anything before we ask some questions?
No, I think you're good. The only thing I would say is just on the U.S. domestic trucking market. I mean, of course, Hurricane Ian really affected trucking capacity and road infrastructure and port operations throughout the Southeast region. And, unfortunately, tender rejections by carriers have really decreased by 77%. Um, from 22.8%, meaning the carriers are really accepting more loads due to having more capacity. And, the spot rates in the market in the trucking arena have really bottomed out to a 16-month low, down almost 35% year to date. While contract rates even fell in the recent weeks after edging up for several months due to the fuel surcharges. So, it's always a roller coaster ride in supply chain and logistics, but especially in the domestic trucking market. So with that, I think we have to send it back to Vanessa and see if we have any questions.
Thank you so much. Today I'm gonna keep my camera off because I am very congested, as you guys can tell by my voice. I do have two questions here. Vessel congestion in LA Long Beach is the lowest since 2020. Rates are lower. Are we finally getting back to normal? Can we forecast that way for 2023? Tough question. Forecasting is always tough. Go ahead, Anthony, Jason.
Here, I'll jump on this first, and Jason can add his essence as always. I don't think that the pricing is ever going to go back to pre-pandemic levels, even though we are seeing rates. Listen, Jason and I talked about it in the beginning of the year at the 2022 Container Outlook. We said that, we researched this, and this specter of inflation, if it were to take off, and now it's spreading like wildfire, and there's no end in sight, demand is going to drop and the market will correct at least 30 to 40%, and it has corrected in excess of 40%. I don't think any manufacturer, importer, business can bank on rates going back to pre-pandemic levels in 2023. I think the market will stay corrected, sort of about where we're at right now. I think the market is almost about ready to bottom out, unless we have some kind of catastrophic financial meltdown globally. But I think everybody has to check their point of sale into demand planning and forecast it properly, because I still think we're in for a wild ride for at least the first half of 2023. Jay.
Yeah, I'm going to go for an unpopular opinion on this and say, do it. Go to the West Coast. And the reason, so a couple little concerns I'd say first are going to be the price is not indicative of some of the issues that they're experiencing right now. So there still are port issues. Also, if you're shipping into the West Coast, you're kind of taking the main highway into the US. So you hit all of the issues all the way through all the supply chains. So let's say you're shipping to the Midwest and you're railing into Chicago, you've got problems there. But, with that being said, there's problems in the rail yard that, is the feeder rail yard for Houston as well. So, problem in Chicago versus in Houston. So I would say go for it with a couple caveats on top of what I just mentioned. We really got to be careful with this ILWU, because it's going to flashpoint greater in California than it will anywhere else in the nation. After it happens in California, everything else will fall like dominoes, and those negotiations will be faster because they're going to kind of set the precedent and they're going to kind of set the terms, and everyone's going to just go over smaller bits. So they will kind of process a little bit quicker. AB5 is still up in the air though as well. So if we have a rail issue and there's also a rail strike on the horizon, and you are kind of hamstrung by the AB5 situation, which, it's still active. We really should actually talk about that a lot more in the coming weeks. It's just when it's going through legislation, sometimes the reports are not a lot to tell you quite yet. Just wait and see. But with those two caveats, the ILWU, the AB5, and obviously some of the things that you can't see beyond the rate, I would say start going back to the West Coast. I mean, it's better at throughput than Houston. It's better at throughput than your other East Coast ports. It's a cheaper rate at the moment. Just make sure you're good friends with your freight forwarder and you've got, a good hookup between their systems and your systems.
Awesome. Question number 2. So many blank sailings from Asia to North America. How are they affected, and and is it going to continue throughout the holiday season?
Vanessa, I think you broke up for a minute,
Yeah, could you
at least
repeat
for
that?
me. Can
Oh,
you
I'm
repeat that?
sorry. Yes.
No worries.
So many blank sailings from Asia to North America. How are they affecting rates? And are they going to continue throughout the holiday season?
I'll just say this before Jay adds. I think that we're going to see an increase of blank sailings, port omissions, port slides, and this is a phenomenon that's going to go on as long as rates continue to fall. Because even though the container ship lines have been on steroids for the last almost 3 years with this pricing, now rates are sliding and they're not happy about it. And here you go. They try to manipulate the space of capacity. Jay, I don't know what your opinion is.
No. I agree. Yeah. So all the blank sailings they're gonna try to prop up rates as best as they can because they just spent all these money on new container ships and now they're not going to be able to use them. So that's part of it. I think the benefit right now on the West Coast is, it used to be a lot of your transloading locations were all in China, and it was a big risk, especially when ports are closing down because of COVID and things like that. But now we've got a couple new ports that have pretty high TU throughput numbers, such as the port that's opening up in Seoul, Korea, that will kind of help, alleviate some of these, oh man, some of these closures and things like that. A little bit lost for a word there, apologize. But so I think with some of those new ports that can act as those transloaders, that will at least lend a little bit more stability. But yeah, no, the attempt of blank sailings and stuff is to elevate rates and get it back to a point where they can make some money.